Bitcoin falling, stocks rising, headlines screaming in both directions. Is this a warning, an opportunity, or just noise? It feels like the market has lost its mind, right? One day everything's up, the next it's a total mess. It's confusing, it's stressful, and it's easy to feel like you're missing something crucial. So today, let's decode one of these crazy market days in simple language, so you can understand what's actually happening and what it means for your money without losing your sanity in the process. First things first, and this is the most important concept to get, there is no single market. That term is a huge oversimplification. When you hear it, it's usually referring to a stock index like the S&P 500. But that's just one piece of a giant global puzzle. The crypto world is its own universe with its own rules and culture. The bond market is another, driven by interest rates and government policy. Then you have real estate and commodities like oil and gold. Each of these markets can react completely differently to the exact same piece of news. So when someone says the market is crazy, what they really saying is that the one part of the puzzle they're rewatching is behaving unexpectedly. Understanding this is the first step to staying calm. So let's walk through a classic example. Bitcoin is down, but stocks are up. How does that even happen? Imagine this scenario. New data comes out in the morning showing that inflation is cooling down a little bit, maybe more than experts predicted. Stock market traders see this and think, great! This means the central bank might lower interest rates sooner than we thought. Lower interest rates mean it's cheaper for companies to borrow money to grow, which can lead to higher profits. So investors cheer and major stock indexes tick up for the day. But at the same time, some people in the crypto world see the exact same news and have a totally different reaction. A popular story for holding Bitcoin is that it's a hedge against uncontrolled inflation and endless money printing. If inflation is cooling, that story gets a little weaker for some. So, traders who are betting on that narrative might decide it's a good time to take some profits off the table, and they start selling. The result? Same news, different stories, different reactions. The stock market celebrates while the crypto market pulls back. It's not chaos. It's just different groups of people interpreting the same information through their own unique lenses. Okay, so these big abstract market moves feel distant, but how do they actually connect to your real everyday life? Think of it like three bridges that connect the world of finance to your world. The first bridge is your investments. This includes your 401k or retirement accounts, any mutual funds you own, and yes, maybe that small bit of crypto you bought. When stocks go up, your retirement account balance looks healthier. When crypto goes down, that part of your portfolio shrinks. The second bridge is your debt. The same interest rate expectations that move the stock market also affect the rates on your credit cards, car loans, and especially your mortgage. News that suggests rates will fall can make future borrowing cheaper, while news suggesting they'll rise can make your existing variable rate debt more expensive. The third bridge is your income and your job. The overall health of the stock market is often seen as a barometer for corporate confidence. When companies feel good about the future, they're more likely to hire people, give raises, and expand. When they're nervous, they might pull back. So these market swings are tied to the stability and growth prospects of the company you work for. So how do you manage all this without driving yourself crazy? The key, the absolute master key, is your time horizon. It is all about separating your money into different buckets based on when you need it. Money you need in the now bucket for the next 0 to 2 years things like rent, your emergency fund, or next year's tuition payment. That money has no business being in risky assets. It belongs in safer places like a high-yield savings account where it won't disappear overnight. Then you have the soon bucket for goals 2 to 7 years away, like a down payment on a house. This can be in a balanced mix, maybe some conservative funds. And finally, you have the later bucket money for retirement that's 10, 20, or even 30 years away. This is the money that can afford to ride the wild storms of the stock market because it has decades to recover and grow. And what about those super high-risk assets, like a single stock or a volatile cryptocurrency? That belongs in a bucket of its own, funded only with money you can emotionally and financially afford to see fall by 50% or more without it ruining your life or derailing your major goals. The goal is to match the risk of the asset to the timeline of the goal. On these mixed-signal days, it's so easy to make mistakes that destroy wealth over the long run. There are 3 big ones to watch out for. The first is panic selling. You see a sea of red on your screen, and your gut screams, "Get out now!" So you sell your long-term investments at a loss, locking in that loss forever, instead of waiting for the inevitable recovery. The second mistake is the opposite: FOMO buying, or the fear of missing out. You see something shooting up, it's all green, and you jump in with both feet at the top, just before it corrects. You're chasing yesterday's news. The third, and perhaps most common mistake, is plan hopping. You have a perfectly good strategy, but you abandon every time a new headline comes out. You're constantly reacting instead of acting on a solid foundation. So, instead of refreshing prices all day and letting your emotions run the show, here's a simple checklist to run through. It turns chaos into a calm, logical process. First, ask yourself, has my time horizon for my goals actually changed? Is my retirement suddenly next year? Probably not. Second, is my asset allocation, my mix of stocks, bonds, and other things, still aligned with my risk tolerance? A 10% drop shouldn't be a surprise if you're invested for growth. Third, do I have a sufficient cash buffer? Having that emergency fund is what gives you the power to not sell your investments in a panic just to cover an unexpected bill. And fourth, are my automatic investments still running? Automating your investing ensures you consistently buy over time, capturing both the highs and the lows, which is a proven strategy for long-term growth. Look, markets are supposed to swing. They are forward-looking pricing machines that are constantly trying to process new information, and they often get it wrong in the short term. Your job is not to predict every twist and turn. That's a losing game. Your job is to build a personal financial plan that is strong enough to survive the storms, so you can reach your goals regardless of the market's daily mood. Remember, this video is for educational purposes only and is not financial advice. Your situation is unique, and it's always best to consult with a professional. But if you want to keep making calmer, smarter money decisions in this very loud world, make sure you follow for more. Thanks for watching.